Hey, hello everyone. David Nicholas. Hope you're all doing well. Hope you're all staying safe, staying healthy. It's spring. This week is the first official week of spring. We're having some beautiful weather here in Georgia. I love the springtime. It's one of my favorite times of year. I was out in the garden over the weekend getting our spring plants and flowers in. But it's also a reminder of, I've never once doubted that spring wouldn't come after winter. As there's been so much uncertainty, so much unknown over the last few years with COVID, geopolitical risks. I've never met anyone, or I haven't myself doubted that spring would ever come after winter, that summer would come after spring, and the fall and winter would come after the summer months. And it's an absolute, it's unchanging. It's something that God set in motion, set in order. But the same way that we shouldn't doubt whether or not the seasons will come or that spring or summer will come when they're supposed to, we also shouldn't doubt the goodness of God and that God loves us and that He has plans for us. And so I'm always just reminded about this time of year about how encouraging it is to see the seasons change, but also it's a picture about God as well, that He's also unchanging, and that the same way we don't doubt the seasons changing, we shouldn't doubt the goodness of God as well. So I pray that encourages you. Well, there's a lot that that's happening. I'll just spend a couple of minutes and share with you what my thoughts are. I want to talk about the Federal Reserve. Talk about this on my radio show a lot. But actually, just this week, we saw that, last week that Powell and the Federal Reserve raised interest rates, but just this week, Powell actually came out and said that inflation is much too high. Now, remember, this is the same Federal Reserve chairman that last year that said, oh, don't worry about inflation. Inflation is just transitory. There's nothing to worry about here long term. I think he was the only person that actually believed that, or maybe he didn't believe that and he just said it not to spook the markets. But this week, this was a pretty big change in Chairman Powell's vocabulary, what he's saying publicly. I mean, Powell said the Fed will continue to hike rates until inflation comes under control. But he also said he can get even more aggressive this year as the Fed changes policy. So, it's a pretty interesting. I'll pull up the CNBC article here that we've been referencing. So Powell says that inflation is much too high, that the Fed will take the necessary steps to address it. Some of the key points that Federal Chairman said in a speech, he noted that rates rise, those rates rising could go from the traditional 25 basis point move to the more aggressive 50 basis point move if necessary. And so this is where I think puts us at a pretty unique standpoint here. So this whole idea, the Fed's last week announced that they were going to raise rates 25 basis points, which we always thought 25 basis points was the number. But I can say going forward, the odds are it's going to be 50 basis points moves, more than likely is what we're going to see. And so one of the things that I just think that we're concerned that we're looking at is really how high is inflation going to go? And I'm just pulling up some of my notes here as I was thinking through some of this. I think inflation is going to be much higher and be much more stubborn than what most Americans probably realize. The concern is that we actually see stagflation. Stagflation, we obviously saw it during the 70s. My hope is that supply chains can come back online and where that's not a risk and that's not an issue. But the challenge right now is that you look overseas with China. I guess COVID is starting to rage over there with a new variant. So they're shutting down areas, they're shutting down supply chains. If supply chains can't come on board quick enough, and this is actually one of the things that Chairman Powell referenced, if I can go to that line here where he referenced that, he says, in normal times when unemployment and inflation are close to our objectives, monetary policy would look to be a brief burst of inflation commodity price shocks. However, the risk is increasing that an extended period of high inflation could push longer term expectations uncomfortably higher. That's a pretty extreme statement for the Fed chairman to say. Basically said that our longer term inflation expectations, those could be moved uncomfortably higher. And I've been saying this for a while. I don't think inflation goes away by the end of this year. Just remember, the Federal Reserve's target is that inflation will be at 2% by the end of the year. I mean, does anyone actually believe that? We're running at 7% current inflation rates, just under 8%. In my opinion, there's no way that inflation gets down to 2%. And what the Fed is basically saying, they're taking a complete 180 and saying the exact word is that long-term inflation expectations will be uncomfortably higher. So that's very concerning, right? And this is where we think that valuations for stocks in a rising rate environment doesn't necessarily bode well. I mean, if you have to think about the next 10 years, and look, I'm a husband and a father. Me and my wife have young kids. You know, I want the future to be brighter for our family. But I think, and I know the same thing you want for your family and your grandkids, but I think if we could define the next 10 years, I think you can define it for global markets as, supply chain disruptions. I think we're going to continue to see geopolitical conflict like we're seeing now, and a period where we have indebted governments with slower economic growth. All right, so that's not a great recipe for success, right? And one of the bigger concerns is like the amount of debt that governments are holding today. That normally means higher taxes. When you're taking money out of the economy, that generally means less economic growth, because unless you haven't noticed, the government is not as great at allocating capital as small businesses, private business enterprises, the free market is. So we never see as much economic growth in a high tax rate environment. The other concern is just where the dollar's headed, right? I can't underestimate the long-term impact of the Saudis being willing to sell oil to China in wons. You may have seen that in the last couple of weeks, but we really haven't seen this before. So obviously, we talked a little bit about the sanctions on Russia. Sanctions on Russia were the right thing to do, but what that told the world is that a lot of these bad actors like China, Russia, you can throw Iran into that mix, it's really been a big wake-up call to them that they need to find alternative reserve currencies for their assets outside of the US dollar. So this is in some ways a reset of the normal global order where the US dollar was king, the US economy was supreme, and every other nation essentially did what they could to make sure that they could trade and interact with US dollars. So we may be seeing some of that. I think China, I don't think most countries are going to jump to that extent to try to get off the US dollar, but I think you're going to see China rapidly do that, right? President Xi, we've seen some of the moves that he's made, but I think that in his lifetime, he's going to want to make some type of move on Taiwan. I don't think it happens in the short term, but in the next decade, if we're just looking over the next 10 years, I absolutely think China does that. You saw what they did with Hong Kong. They're watching what Russia's doing in Ukraine. I think they make a move on Taiwan. That obviously affects supply chains with semiconductors. There's a whole litany of products that affects as well. Divide in Europe will continue, right? East and Western Europe, as this Ukraine and Russia issue plays out. So, in some ways, this is going to be a turbulent market for stocks, I think, over the next 10 years. Price to earnings ratios, the PE for the market right now is sitting at about 25. Actually, I want to bring up that chart so I can show you what that looks like. So current PE ratios for the market are 25. The historical average has normally been about 15 or 16. As I bring up my chart here, current PE chart, S&P, because I think this is worth looking at as well. Just where are valuations relative to historicals? So let me pull this up here. Okay. So what you can see is here's price to earnings ratio. So this tells us the multiple that we pay for stocks based for every share that we purchase based on their earnings. Right now, the PE ratios for stocks in the US are trading at 25 times earnings. Okay, this was during COVID. There weren't any earnings, so it jumped. It's certainly come down, but the historical average, the average has been right around 16. So what that tells us is buying stocks today, you're still paying a pretty high premium than you have historically for stocks. So, well, what does that mean, David? Does that mean that, or how do we change that? Are stocks going to be so much more profitable that earning number comes down? Or is it that the stock price goes down to impact that PE ratio? And we think it's that stock prices come down. So this is why you got to be vigilant right now. But this is why we've also shared inside of our investment and retirement strategy is you've got to have a bucket of your portfolio that's not really affected by the movements of the markets, right? So you got to have that income bucket piece that's going to generate income during those first 8 to 10 years of retirement. And the growth bucket, because I think right now, equity valuations from a relative historical standpoint, it's pricey. And I don't think the economic outlook for stocks in the short term is something to get very excited about. So we're not overly optimistic on that. So that tells us that stock prices are probably going to head lower in the future. So this is why you got to own the right names. You got to have the right breakdown in the portfolio. One of the other things you can look at is the Warren Buffett indicator, where you take the market cap of GDP and you divide that by the market cap of the stock market. Well, the stock market is almost 200% higher than our GDP. So the market cap of the stock market is about 200% higher than current GDP. So that's concerning as well. And so again, there's multiple areas that we can look at where I could make a case. I can make a pretty bearish case of what the next 10 years looks like. We are optimistic. So our client, if you're a client of ours, the stuff that we've been talking about. If you're not a client of ours, I would tell you that our clients hire us because they've already built their wealth and they hire us to preserve it, to hold on to it, to get them a reasonable rate of return. And this is why we're actively looking at companies that have been growing their dividends for the last 20 plus years. So in this environment, you want to own companies that have great cash flow, manageable debt, that are growing year over year, pretty good growth rates, but they're growing their dividends. And this is why we've been focusing on that, to own some of these quality companies. You don't want to own the unicorn companies that don't have any earnings, that are speculative in nature. So you really want to be owning the names that are going to be providing growth, but can also increase dividends in a rising interest rate environment. So there's a lot that we're watching. The best thing I could sum this up is the Federal Reserve got it wrong. The Federal Reserve absolutely got this wrong. I don't know how they're going to fix it, because if anything, I think they're going to exacerbate the problem. I talked about a little bit in the 70s during Volcker. We touched on this last week. Volcker raised rates 1979, took prime from 11 to 20%. Once the Federal Reserve raised rates in the 70s, that caused 2 recessions in 1980 and 1981. So history is not on our side in a rising interest rate environment. My fear, though, is that inflation has gotten so far and gotten so out of control that the Federal Reserve is now going to have to be pretty aggressive with catch-up. So I would look for short-term rates to rise pretty substantially over the next 6 to 12 months. So this is why, if you're listening right now, because this wouldn't be the case with our clients, but if you've got a sizable bond portfolio, you may not even realize, but if you're approaching retirement or in retirement, you could have 40 to 50% of your portfolio in bonds. And I think bonds are as close to guaranteed to lose money over the next 10 years as anything I've probably said in a long time. It's going to be very hard to make money in bonds over the next 8 to 10 years. So this is why you've got to have an asset class in your portfolio, in a retirement portfolio, can generate dividends, generate income, but doesn't have the interest rate risk like bonds carry in a rising interest rate environment. So anyways, just wanted to give you an update on the stuff that we're watching the Federal Reserve. I wanted to give you the timely update that Jerome Powell came out this week, basically got it wrong on inflation. I'll leave you with his parting words again. He said that inflation is much too high. Welcome to something that everyone else has already knew, and the Fed will take the necessary steps to address it. So pretty big stuff, pretty big switch compared to what the Federal Reserve was saying less than 12 months ago. So look for that to show up in the next Federal Reserve rate hike meetings. I think it's no question that we see at least a 0.5 point rate hike. We could see even more than that, with potentially 6 rate hikes this year. Well, again, David Nicholas, thank you so much. If you're a client of ours, thank you so much. We're honored to serve you. If you're not a client of ours, just know we'd be honored to help. You can respond to this email or let our team know. We're happy to answer any questions that you might have. Have a blessed week. I'm David Nicholas. We'll talk to you soon. Bye-bye.